the land of the free loses its risk-free returns. Hello and welcome to today's Daily Blitz. Now, recently, the entire US yield curve has fallen below America's rate of inflation. Now, Nikolai, what do you think this means? Because it's quite a rare event for this to happen, right?
Right, so the last time this happened was in 2017, and what it really tells us is that the return on investing in US government bonds is less than what you'd expect the prices of consumer products in the US to increase by, suggesting that really investors are not making money by investing in US government bonds anymore. What makes that especially interesting is that US government bonds are considered the global risk-free asset. So they're supposed to be sort of the benchmark against which all other returns are measured. And if you can't make any money in real terms in that asset, then everything else sort of has to shift to adjust for that as well. And investors should theoretically be piling out of US government bonds and into other assets.
Now, we should note that before 2017, this simply did not happen. It's an incredibly rare event for the entire US yield curve to be underneath. Investors cannot get any return through investing in government bonds that is greater than inflation. Now, what this does, as Nikolai alluded to, is pushes investors further into the risk curve. So they had to take on more risk with more credit risk specifically and more currency risk specifically than with the US government bonds. So this could be investing in riskier bonds, it could be investing in stocks, it could be investing in other assets that derive some kind of yield. Now, as you'll know from watching previous episodes of the Daily Blitz, you'll know that I believe that 2020 will see a rerun of all of the stock market events of 2017. And this further adds to that argument. And one of the reasons why we had such a terrific return for the stock market in 2017 and for alternative assets like cryptocurrencies was because investors were just reaching for that yield. They were trying to find real returns outside of government bonds because they couldn't get it anymore.
And one of the interesting places they'd like to look is in places that don't usually have any yield at all, such as gold. Because suddenly when you're not earning any sort of real returns from bonds, you might as well be holding assets that don't pay any income. And those assets are likely to outpace inflation, at least.
Exactly. So why would you hold an investment that pays you less than nothing when you could simply buy gold that pays you nothing?
But the worry for all investors about this should be what ended up happening after 2017. It's not sustainable to have your entire yield curve sitting below the rate of inflation. That didn't last time around in 2017. Eventually, those bonds plunged and interest rates returned to much higher than the rates of inflation, at least for parts of the yield curve. So we would suggest that this is not a sustainable sort of situation overall. Something will eventually have to change. The question is when and how markets will trend in the meantime.
However, it should be noted that perhaps we have just entered a new normal where bondholders all across the yield curve are just simply going to get destroyed by inflation as the US government needs to spend what it needs to spend and bondholders simply need to pay for it. But if this does occur, that is a completely new paradigm for financial markets in general. So watching whether or not the US government yield curve does remain below the pace of inflation is something that everybody should be looking for, because if it does really change, everything else changes with it. But that sums up today's Daily Blitz. We hope you enjoyed it. Be sure to subscribe and click the notification bell down below, and we'll see you in the next one.